Preparing for a FP&A Analyst at NextEra Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to join NextEra Energy in FP&A. I'm an analytical finance professional with experience in budgeting, forecasting, variance analysis, and Excel-based modeling. I'm attracted to NextEra because it combines regulated utility operations with large-scale renewable energy investment, creating a complex but meaningful FP&A environment. In prior work, I partnered with operating teams to explain performance rather than simply report numbers. I would bring strong attention to detail, curiosity, and disciplined communication while developing deeper expertise in energy economics, capital planning, and long-term growth drivers. While answering, focus on your analytical foundation, financial modeling experience, interest in the energy transition, and ability to connect detailed analysis with operational decisions in a large, capital-intensive utility and renewables business. Question 2. What does FP&A contribute to a company like NextEra Energy? FP&A turns operational information into forward-looking financial decisions. At NextEra, that means coordinating budgets, updating forecasts, explaining variances, evaluating capital needs, and helping leaders understand earnings and cash flow implications. FP&A also provides a common language between finance, generation, transmission, development, and corporate functions. I would view the role as more than producing reports. It is about challenging assumptions, identifying risks early, and presenting practical recommendations that support reliability, disciplined investment, and sustainable growth. Make sure to cover budgeting, forecasting, management reporting, business partnering, capital allocation, scenario analysis, and how FP&A supports reliable service, earnings visibility, cost control, and investment decisions across regulated and competitive businesses. Question 3. How would you build an annual budget for an electric utility and renewable energy company? I would begin with corporate guidance, historical actuals, strategic priorities, and key operating assumptions. I would model revenue by business driver, including demand, pricing, generation, and project timing. Then build expense and capital schedules with input from operating owners. I would challenge unusual assumptions, reconcile each segment to consolidated targets, and document sensitivities such as weather, fuel prices, interest rates, and construction delays. Finally, I would obtain leadership approval and establish monthly variance ownership against the budget. In your answer, talk about establishing assumptions, gathering operating inputs, separating fixed and variable costs, modeling generation and demand, incorporating capital projects, reviewing business unit submissions, and reconciling the plan to strategic and financial targets. Question 4. How do you forecast revenue for a regulated utility? I would forecast regulated utility revenue by linking customer demand and approved rates to expected sales, then layering in regulatory mechanisms, riders, customer growth, and known filings. I would separate recurring base revenue from timing-related or non-recurring items. Weather normalization matters because heating and cooling demand can materially affect results, so I would use historical relationships and current forecasts. I would also reconcile the model with regulatory assumptions and clearly identify risks from rate decisions, load changes, or unusual weather. Be sure to mention rate base, approved rates, customer demand, weather normalization, regulatory outcomes, rider mechanisms, customer growth, revenue timing, and the importance of coordinating with regulatory, operations, and accounting teams. Question 5. How would you forecast revenue from a renewable energy project? For a renewable project, I would start with the commercial contract, pricing structure, expected commercial operation date, and production profile. I would forecast generation using resource assumptions, capacity, degradation, availability, and potential curtailment, then apply the relevant pricing and incentive mechanics. I would distinguish contracted revenue from merchant exposure and model construction or interconnection delays explicitly. I would validate assumptions with project and engineering teams, compare production with historical or benchmark data, and refresh the forecast as milestones change. Focus on contracted pricing, expected production, resource availability, project commissioning, curtailment, degradation, tax incentives, merchant exposure, and validating assumptions against engineering, commercial, and project management inputs. Question 6. Walk me through how you would analyze a monthly budget variance. I would first identify material variances using both dollar and percentage thresholds, then disaggregate them into price, volume, mix, timing, and one-time drivers. I would validate the result against the general ledger and operational metrics before discussing causes with the responsible business partner. For example, an unfavorable expense variance could reflect storm repairs, delayed project timing, or an incorrect accrual. I would document the explanation, assess whether it changes the outlook, and recommend an action or forecast adjustment. Make sure to cover identifying material deviations, separating volume, price, mix, timing, and one-time effects, validating data, engaging business owners, determining root causes, and converting findings into forecast updates or corrective actions. Question 7. What is the difference between a budget, forecast, and long-range plan? A budget is the approved financial plan for a defined period and provides a baseline for accountability. A forecast is the current best estimate of what will actually happen, incorporating updated information and management actions. A long-range plan extends several years and connects strategic priorities with growth, capital, financing, and earnings objectives. In practice, I would use the budget to measure execution, the forecast to manage near-term performance, and the long-range plan to test whether decisions support the broader strategy. In your answer, distinguish the approved operating commitment, the latest estimate of expected performance, and the strategic multi-year view, including differences in purpose, frequency, assumptions, accountability, and level of detail. Question 8. Which financial and operating metrics would you monitor at NextEra Energy? I would monitor earnings and cash flow alongside operational drivers. For the utility, relevant measures include customer growth, electricity demand, operating and maintenance expense, capital spending, rate base, reliability, and regulatory recovery. For renewables, I would track megawatts developed or placed in service, generation, availability, project margins, power prices, and construction milestones. At the consolidated level, I would also monitor liquidity, leverage, interest expense, and forecast accuracy, because strong operating results must translate into sustainable financial performance. Be sure to mention earnings, cash flow, operating costs, capital spending, rate base, customer growth, generation, availability, project milestones, leverage, and renewable development metrics, while tailoring measures to each business segment. Question 9. How would you evaluate a capital investment in a solar, wind, or battery project? I would build an unlevered and, if relevant, levered project model using construction costs, operating expenses, production, degradation, contract pricing, tax benefits, useful life, and terminal assumptions. I would calculate NPV, IRR, payback, and cash-on-cash returns, then stress test resource availability, delays, inflation, rates, curtailment, and power prices. I would compare the risk-adjusted economics with funding requirements and strategic benefits. The recommendation should explain not only whether returns clear the hurdle, but also which assumptions drive value. Focus on incremental cash flows, construction cost, operating assumptions, tax benefits, contracted versus merchant revenue, NPV, IRR, payback, financing, risk-adjusted scenarios, and strategic or regulatory considerations beyond headline returns. Question 10. How do interest rates affect NextEra's FP&A forecasts? Higher interest rates can increase interest expense on floating rate debt, raise refinancing costs, and make new project financing more expensive. They can also increase discount rates, lowering project valuations and potentially changing investment timing. For a utility, affordability and regulatory recovery considerations may influence how costs are managed or recovered. I would model rate scenarios by debt maturity, financing assumptions, and project schedules, quantify earnings and cash flow impacts, and distinguish near-term contractual effects from longer-term capital allocation consequences. In your answer, cover debt refinancing, interest expense, project financing, discount rates, valuation, customer affordability, capital timing, sensitivity analysis, and the distinction between direct earnings effects and longer-term investment consequences. Question 11. How would you incorporate inflation and supply chain risk into a forecast? I would separate inflation-sensitive costs such as labor, materials, fuel, maintenance, and construction equipment rather than applying one broad rate. I would review vendor contracts, escalation clauses, procurement updates, and project contingencies, then reflect expected timing and probability of delivery delays. I would create base, upside, and downside cases showing effects on capital spending, operating expense, project completion, and cash flow. I would refresh assumptions through monthly business partner discussions and flag risks early enough for sourcing or scheduling actions. Make sure to cover cost driver segmentation, supplier contracts, escalation clauses, labor and equipment assumptions, project contingencies, timing risk, scenario analysis, mitigation plans, and updating forecasts when market evidence changes. Question 12. Describe an Excel model you would build for FP&A and how you would ensure it is reliable. I would structure the model into clearly labeled assumptions, operating schedules, financial statements, outputs, and checks. Inputs would be centralized, formulas would flow consistently, and hard-coded values would be limited and documented. I would include balance checks, historical tie-outs, error flags, scenario switches, and sensitivity tables. Before distribution, I would compare outputs with source systems and prior versions, review unusual movements, and ask another analyst to test the logic. Good model design makes updates faster while reducing key person and formula risk. Focus on clear inputs, calculations, outputs, consistent formatting, linked schedules, checks, version control, documentation, sensitivity functionality, independent review, and avoiding hard codes that could undermine auditability or forecast integrity. Question 13. How would you explain a complex financial variance to a non-finance operating leader? I would lead with the conclusion, quantify the largest drivers, and connect each driver to an operational event. Instead of saying margins declined because of unfavorable mix, I might explain that lower wind production and higher balancing costs reduced earnings by a specific amount. I would separate controllable actions from external factors, use a concise bridge or chart, and confirm the leader's understanding. I would finish with the forecast implication, assigned owner, and next step rather than simply presenting a variance. Be sure to mention leading with the business conclusion, using plain language, quantifying the largest drivers, separating controllable from uncontrollable items, avoiding jargon, and ending with implications, ownership, and recommended actions. Question 14. What would you do if actual results materially differed from your forecast? I would first verify that the variance is real by checking source data, accounting treatment, cutoffs, and operational inputs. Then I would isolate whether the miss resulted from an incorrect assumption, timing difference, an unexpected event, or a process weakness. I would communicate the issue promptly, quantify the revised outlook, and update the model with documented assumptions. Afterward, I would review the forecasting approach with stakeholders and add a control, driver, or monitoring step to reduce the chance of recurrence. In your answer, discuss owning the issue, validating data, performing root cause analysis, checking assumptions and timing, communicating promptly, correcting the model, and improving the forecasting process without becoming defensive. Question 15. How do weather patterns affect utility financial planning? Weather affects electricity demand, renewable generation, storm-related costs, and sometimes market pricing. Hotter or colder periods can increase utility sales, while weak wind or low solar irradiance can reduce renewable production. I would compare actual conditions with normal weather, quantify the financial impact, and avoid treating temporary effects as structural growth. Forecasts should include seasonal patterns and weather scenarios, while management reporting should distinguish weather-driven results from customer growth, efficiency, pricing, and operational performance. Focus on heating and cooling demand, load variability, normalization, storm costs, renewable resource variability, seasonal patterns, scenario ranges, and distinguishing weather-driven effects from underlying customer or operational trends. Question 16. How would you assess forecast accuracy and improve it over time? I would measure forecast accuracy using absolute and percentage errors, but also examine bias to see whether the process consistently over or under forecasts. I would analyze results by business unit, driver, forecast horizon, and materiality, separating controllable modeling issues from unusual events. After each cycle, I would conduct a short postmortem with stakeholders, update assumptions or methods, and improve data quality. The objective is not perfect precision, it is a transparent forecast that reliably supports decisions and highlights uncertainty. Make sure to cover accuracy metrics, bias, materiality, driver-level analysis, forecast horizons, accountability, postmortems, statistical or operational inputs, and balancing model sophistication with usability and decision relevance. Question 17. Tell me about a time you worked with a difficult stakeholder or challenged an assumption. In one forecast cycle, an operating manager submitted expense growth well below historical run rates. Rather than rejecting it, I reviewed the underlying activity drivers and asked what operational changes supported the assumption. We found that one reduction depended on a contract renegotiation that had not yet been finalized. I modeled both outcomes, presented the risk transparently, and agreed on a probability-weighted forecast with a tracking action. That approach improved forecast credibility and strengthened the relationship because the discussion focused on evidence, not blame. In your answer, use a specific situation, explain the conflicting assumption, show respectful fact-based questioning, describe how you built alignment, quantify the result, and demonstrate that the relationship remained productive. Question 18. How do accounting results flow into FP&A analysis? FP&A relies on accounting data as the foundation for actuals, but must understand how accounting treatment affects interpretation. I would review the general ledger, accruals, depreciation, capitalization, regulatory items, and close adjustments before explaining performance. A project delay, for example, could shift costs between capital and expense or change depreciation timing. I would reconcile management reports to accounting records, investigate unusual entries, and clearly separate reported results from operational measures so leadership receives an accurate, decision-useful explanation. Be sure to mention the general ledger, accruals, depreciation, capitalization, regulatory accounting, reconciliations, close timing, management adjustments, and the need to understand accounting before interpreting operational performance. Question 19. Why are cash flow and capital allocation especially important in the energy sector? Energy companies require substantial capital for generation, transmission, grid modernization, and renewable development, often before projects produce cash. Therefore, FP&A must connect earnings plans with capital spending, construction timing, financing, liquidity, and debt capacity. I would evaluate whether investments meet return thresholds while supporting reliability, regulatory obligations, and strategic growth. I would also monitor free cash flow, funding gaps, and sensitivity to rates or delays. Strong capital planning helps balance infrastructure needs with dividends, credit quality, and shareholder returns. Focus on high capital intensity, long project lives, construction timing, financing needs, regulated investment recovery, liquidity, returns, dividends, debt capacity, and balancing reliability, growth, and shareholder commitments. Question 20. Why should we hire you for this FP&A analyst role? You should hire me because I combine financial discipline with practical curiosity. I can build and audit Excel models, reconcile data, explain variances, and communicate conclusions clearly to both finance and operating audiences. I also take ownership when assumptions change or results miss expectations. NextEra's combination of regulated utility operations and renewable investment particularly interests me, because it requires both precision and strategic thinking. I would contribute as a dependable analyst immediately while continuously learning the company, industry, and decision processes. In your answer, summarize analytical skills, accounting discipline, Excel capability, communication, ownership, energy sector motivation, adaptability, and examples showing you can turn accurate analysis into useful recommendations for business partners. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.